The financial world roars with information, a constant barrage of news, opinions, and predictions. Are you listening to a symphony of insight, or are you drowning in noise? The sheer volume can be paralyzing, a blizzard obscuring the true path to sound investment decisions. We are bombarded daily, and it's easy to mistake hype for substance. But what if the news itself isn't neutral? What if hidden biases are subtly shaping the narrative, leading even the most diligent investors astray? These aren't always deliberate manipulations, but rather ingrained psychological tendencies amplified by the speed and reach of modern media today. We're pulling back the curtain. We're not just offering another opinion. We're equipping you with a lens, a data-driven framework to identify and neutralize 5 pervasive biases lurking within investment news. Think of it as building your own personal signal filter, inspired by Benjamin Graham's unwavering focus on facts and independent analysis. This isn't about dismissing financial media outright. It's about becoming a more discerning consumer, an intelligent investor who can extract valuable information while guarding against psychological traps. We'll explore how biases like anchoring, confirmation bias, and recency bias can distort our perception of risk and opportunity. Imagine being able to sift through the headlines, identify the underlying biases at play, and make investment decisions based on clear, objective data. This is the power of critical thinking, the ability to challenge the prevailing narrative and forge your own informed path. Are you ready to move beyond the noise and discover the hidden biases that could be impacting your investment decisions? Are you ready to cultivate a truly data-driven approach, one that empowers you to navigate the complexities of the market with confidence and clarity? Then let's begin. Our first hidden bias is the availability cascade. Imagine a pebble dropped into a still pond. The initial splash is dramatic, attention-grabbing, but the ripples spread far beyond, influencing the entire surface. That initial splash is like a sensational headline, a vivid, emotionally charged story that imprints itself on our minds. The availability cascade explains why we often overestimate the likelihood of dramatic but rare events. Think about it. News coverage of a plane crash is intense, dominating headlines for days. Yet, statistically, you're far more likely to be injured in a car accident. The vividness of the plane crash makes it more available in our memory, skewing our perception of the actual risk. This isn't just about innocent reporting. The media thrives on attention, and if it bleeds, it leads isn't just a catchy phrase, it's a business model. But this focus on the sensational actively distorts our rational risk assessment when it comes to investing. A rare, dramatic financial event, like a sudden market crash, can overshadow the far more common and often more damaging impact of everyday investment mistakes. So, what can we do? Implement a news curfew. Consciously limit your exposure to sensational financial news, especially during periods of market volatility. Recognize that your initial reaction to a shocking headline is likely influenced by this bias. The availability cascade is like a funhouse mirror, reflecting a distorted image of reality. True insight lies not in the fleeting drama, but in the cold, hard data. Data is the true reflection, the unvarnished truth that allows us to see beyond the hype and make informed decisions. Question every headline, challenge every fear-inducing narrative, and ground yourself in the objective reality of the numbers. Now, let's navigate the treacherous waters of anchoring bias. Imagine a ship setting sail, its anchor firmly planted in the harbor. Even as the ship moves, that initial anchor point exerts a subtle, yet persistent pull. This is precisely how anchoring bias works in the context of investment news, particularly when it comes to earnings reports. Anchoring bias causes us to fixate on initial pieces of information, like headline earnings figures, and fail to adequately adjust our judgment based on subsequent data. A company might beat earnings estimates, triggering a wave of positive news coverage and investor enthusiasm. But what if a deeper analysis reveals a concerning trend, declining revenue growth, shrinking profit margins, or increasing debt? The initial positive headline acts as an anchor, preventing investors from fully appreciating the underlying weaknesses. They flock to the stock, seduced by the apparent success, while ignoring the warning signs beneath the surface. Beating earnings estimates in isolation is not always a sign of a healthy company. It's crucial to look beyond the immediate numbers and assess the overall trajectory of the business. The technique: always compare current results to historical trends and industry benchmarks, not just the previous quarter's numbers or analyst expectations. Ask yourself, is this growth sustainable? Is the company outperforming its peers? What are the long-term implications of these results? Anchoring bias is like setting sail with a faulty compass. You're headed in the wrong direction from the start. Don't let those initial numbers be your faulty compass. Discard the anchor of initial impressions and navigate with the clear, consistent light of comprehensive data. Only then can you chart a course toward truly informed investment decisions. Let's confront the allure of the bandwagon effect. Imagine a crowd surging forward, caught up in a frenzy of excitement. The energy is contagious, the momentum momentum irresistible. But what if the crowd is headed straight for a cliff? This is the danger of the bandwagon effect, the tendency to do what others are doing, regardless of your own independent analysis. The bandwagon effect is particularly potent during market bubbles. As prices rise, fueled by speculation and hype, everyone seems to be buying. The fear of missing out FOMO kicks in, and even seasoned investors can succumb to the herd mentality. Everyone's buying, the thinking goes, so it must be a good investment. But is it really? Analyst ratings often reinforce this bandwagon effect. The myth is that these ratings are unbiased, the product of thorough, independent research. The reality is that they often reflect prevailing market sentiment, chasing the upward trend rather than identifying true value. So, how do we resist the siren song of the crowd? Conduct independent research and develop your own investment thesis. Don't rely solely on analyst ratings or popular opinion. Dig into the fundamentals, understand the business model, and assess the long-term prospects. Remember Warren Buffett's timeless wisdom: be fearful when others are greedy, and greedy when others are fearful. The bandwagon is often headed over a cliff, driven by emotion rather than reason. Dare to be different. Dare to think for yourself. The greatest investment opportunities often lie where the crowd is afraid to tread. Cultivate independent thinking, and you'll find your own path to lasting wealth. Let's examine the insidious grip of confirmation bias. Imagine yourself walking through a crowded marketplace, but only seeing the stalls that sell what you already want to buy. You ignore the vibrant colors, the enticing aromas, the unique offerings of the other vendors. This is the essence of confirmation bias, seeking out information that confirms our existing beliefs, while conveniently ignoring contradictory evidence. An investor convinced that a particular stock will rise might only read positive news articles about the company, dismissing any red flags or dissenting opinions as irrelevant noise. They create an echo chamber, reinforcing their initial conviction and blinding themselves to potential risks. Here's a counterintuitive truth: being right all the time is a red flag. It suggests that you're not challenging your assumptions, not exposing yourself to diverse perspectives. True learning and sound investment decisions require intellectual humility, the willingness to admit you might be wrong. The technique to combat this: actively seek out dissenting opinions and alternative perspectives. Play devil's advocate with your own investment ideas. Ask yourself, what are the potential downsides? What could invalidate my thesis? What are the arguments against this investment? Confirmation bias is like wearing blinders, preventing you from seeing the full picture. Take off those blinders. Embrace intellectual honesty. Seek out the truth, even when it's uncomfortable. The ability to challenge your own beliefs is the cornerstone of intelligent investing and a safeguard against costly mistakes. Finally, let's confront the paralyzing fear of loss aversion. Imagine holding two objects, one you've earned and one you're simply holding for a friend. The thought of losing the object you own creates a far greater sense of anxiety than the thought of losing the borrowed one. This is the power of loss aversion, the tendency to feel the pain of a loss far more strongly than the pleasure of an equivalent gain. In the investing world, this manifests as investors selling winning stocks prematurely to lock in profits, driven by the fear of those gains disappearing. Meanwhile, they stubbornly hold on to losing stocks, hoping for a miraculous rebound, unable to confront the reality of their mistake. Locking in profits might seem prudent, but it can severely limit long-term compounding and lead to significant underperformance. By cutting your winners short, you miss out on the potential for exponential growth. The technique to overcome this: set clear price targets and stop-loss orders based on your initial investment thesis, not emotional reactions to market fluctuations. Define your reasons for buying a stock in the first place and establish objective criteria for when you'll sell, regardless of how you feel about the investment at any given moment. Loss aversion is like pulling up a flower to check its roots, preventing it from ever fully blooming. Resist the urge to constantly tinker with your portfolio, driven by fear and short-term market noise. Nurture your investments, give them time to grow, and reap the rewards of patient, disciplined decision-making. We've journeyed through a landscape riddled with hidden traps, uncovering 5 pervasive biases that can distort our perception of financial reality: the availability cascade, anchoring bias, the bandwagon effect, confirmation bias, and loss aversion. These aren't abstract concepts. They are powerful psychological forces that can subtly yet significantly impact our investment decisions. The key takeaway: cultivate a data-driven mindset. Embrace critical thinking, independent research, and a healthy dose of skepticism. Don't blindly accept the narratives presented by financial news sources. Question the underlying assumptions, challenge the prevailing sentiment, and demand objective evidence. Remember Benjamin Graham's emphasis on a margin of safety. This isn't just about buying undervalued assets. It's about building a buffer against our own cognitive biases, recognizing that we are all susceptible to errors in judgment. Develop your own investment thesis, grounded in fundamental analysis and a long long-term perspective. Focus on the intrinsic value of businesses, not the fleeting emotions of the market. Ignore the short-term noise and concentrate on the enduring principles of value investing. The path to financial mastery isn't about predicting the future. It's about understanding the present and making rational decisions based on sound principles. By recognizing and mitigating these hidden biases, you can shield yourself from the manipulative forces of the media and navigate the complexities of the market with greater confidence and clarity. So, as you navigate the daily deluge of financial news, ask yourself, am I being swayed by emotion or guided by data? Am I following the crowd or forging my own path? The answer to these questions will determine your success as an investor. Are you ready to embrace the power of data-driven decision-making and become a truly intelligent investor?